So please go to your slide on 50. So slide on 50 is mortgage not payable 应付抵押款. Remember what is mortgage not payable? It means we issue the note with collateral, right? Like we use our house, our car, our other assets as collateral to give creditors more guarantee. So there's mortgage not payable 应付抵押款. Okay, we mentioned this at your first year, but be careful is what? Mortgage not payable. You should know when you pay back the principal. A maturity date means you pay back the principal once at the maturity date, or is installment payment 分期付款. So installment payment 分期付款 means what? We pay principals, part of principals each period, okay? But be careful how we report the situation on your financial statements. If you pay the principal at maturity date, so means what? You pay back the principal after 5 years, after 10 years, so on. So the principal should be your non-current liability. So when we look at the financial statements, we will find out our liability on non-current liability, okay? Because we are going to pay back the principal more than 1 year. But when it's installment payment 分期付款, then you should be careful. What's that? We pay principal each period, each year, okay? So for your first installment payment, you are going to pay within 1 year. You should put it into current liability. Other principals you are going to pay back more than 1 year, then we will put it into non-current liability. So when we are going to prepare financial statements, you should be very careful when you pay back the principal at maturity date or installment payment. For installment payment, you should note some of your principal, you should put it into current liability, others into non-current liability, okay? So that's a concept also from your first year. Any questions? So for bonds, for notes, issue the bond, issue the note, how we deal with the questions, problems. We already done this. So what's the next? Next is extinguishment, 负债消灭. On your slide 53. So extinguish, 负债消灭, what does it mean? Actually, we talk about that in your first year. When we pay back the money, so means we don't have the liabilities. So we don't have the liabilities. That's extinguishment, 负债消灭. Okay? So extinguishment means we don't have the bonds payable. We don't have the notes payable. Then why? For your first year, we just talk about the first two cases. Why we don't have the bond anymore? Because first case is quite simple. What's that? Your company hold the bond to maturity, means you pay interest each period. Then after 10 years or after 20 years, at maturity date, when we pay back the principal, then we don't have the liability anymore, right? So that's case 1. So case 2 also, we talk about that at your first year. What's that? Before maturity, you decide to pay debt, to pay back the debt before maturity. So you decide to what? Call your bond, buy back your bond earlier, okay? So we mentioned the first 2 at your first year. Intermediate accounting will tell you 2 more cases, okay? But today we don't have the time for these 2 more cases. Case 3, case 4, we don't have time. Even though for case 2, I think there will be very big trouble for you guys, because right now it's more complicated, more like a real world. So it's not everything 100%. It's not everything on interest payment day. It's not. So for case 2, I think it's only for today. We could maybe talk about case 2, okay? So case 1 is the normal case. So I don't want to talk about that again. For case 2, we mentioned this. Your company decide to buy back the bond earlier. Why? You want to pay your debt earlier. Remember, first thing is what? You should have the money, right? So on your financial accounting, we told you why you want to pay back, to buy your bond back earlier. Of course, first, I have the cash. And for the cash, I don't know where to use my cash. Okay, since I have too much money, I don't know where to spend my money, then okay, I decide to pay back my debt. At least I don't need to pay interest anymore, right? So first year we mentioned you should have enough cash and use the enough cash to pay the debt earlier, because you don't want to pay your interest. So after you pay back, you don't have interest anymore. Also, that makes your liability decrease, right? Okay? Any questions? Then, right now, intermediate accounting here told you, even though you don't have enough cash, still you will pay the debt earlier. Why? So, perfect world in your first year told you, you have too much cash. So of course I have a cash, then I could pay my debt. But real world, it's not necessary. I have enough cash. So even though today I don't have the cash, still I decide to pay my debt earlier, to buy back my bond earlier. Why is that? Okay? So here told you why, even though I don't have the cash, but today I still want to buy back my bond earlier. Why? Because I don't have the cash. How I can pay the debt? I don't have the money. How I can pay the debt? I borrow the money today to pay the money I owed before. Okay, so what does it mean? I issue the new bond today, got the money to pay debt for my old bond. Okay, then why I want to do that? So what does it mean? Means today, this is today, I want to buy back my old bond. So this is your old bond. So your old bond, you issue the old bond maybe 5 years ago, or maybe 2 years ago. Okay, so maybe 2 years ago. So maybe on this is 2020, you issued bond. So this bond, if we call it A, okay? So in 2020, you issue the bond. So you owe the creditors, investors money. And after 2 years, for example, after 2 years, in 2022, on this day, you decide want to buy back your old bond. So for your old bond, you decide to buy back before maturity date. But do you have the money? I don't have the money. Since you don't have the money, how could you pay the debt? Impossible. So what should we do? Borrow another money. So in 2022, I decide to issue bond B. So decide on this date, issued another bond. If we call it B, okay? So I issue another bond B, then you will get what? Money, right? So I'll get the money, for example, if I got the cash. How much it is? Maybe 95. Okay. So in 2022, I decided to issue bond B, get the cash 95, and use the cash 95 to pay, to buy back my old bond. Okay. Then I use 95. To buy back old bond. Old bond means bond A. Okay, so that's how we still could pay the debt, buy back the bond before maturity date for your bond A01, even though I don't have the cash. So I borrow more money, issue new bond in order to buy back my old bond. Okay? Then why you want to do that? Because today, in 2022, the market interest rate is higher or lower than market rate in 2020, your 01. Higher or lower? Lower, right? So today in 2022, your market interest rate lower. So for example, only 6%. So what does that mean? I issued new bond. I just need to pay 6% interest rate for the following years. Okay? But how about your old bond? Your old bond in 2020, when you issue the bond in 2020, the market interest rate is 10%. So what does it mean? Means each period you had to pay interest 10%. So how to reduce your interest expense? When you find out market interest rate decrease, right? Market interest rate decrease means what? The interest you had to pay decrease. Okay? So I of course issue new bond with a lower interest rate to buy back old bond with higher interest rate. Then for the following years I just pay lower interest expense. Okay? So did you find out? New bond, lower interest rate, I pay lower interest expense. Old bond, higher market interest rate, I have to pay higher interest expense. So of course I use the new one, replace the old one. Then I could save the interest expense. In this case, for example, 4%. Okay? So this is the reason why your company want to do that, even though you don't have the money. So here I told you on your slide 57, you want to replace it, means old bond. Buy back your bond earlier with the new one. Why? Because new one have the lower market interest rate. Lower market interest rate, you could pay lower interest expense. So replace old bond with the new one because new one have lower market interest rate. So that's refunding. 举新债还旧债。OK。Okay, so based on this, you understand we have so many reasons. This is one of the reasons why we want to buy back bond earlier to save our interest expense. Okay, so let's go back to our accounting. So for the case, how we deal with record the situation. You know, we focus on buy back the old bond. But how about issue the new bond? Totally the same as before, right? So that's why we don't mention this part is you got the cash 95. So in this case, if you got the cash, issue the new bond, got the cash 95. So what should we recall it? Got the cash 95, right? So I have bonds payable 95. So totally the same as before. After you got the cash, so we focus on the old bond. We use the $95 to buy back our old bond, right? So we use that $95 to buy back the old bond. How could we record the situation? Okay. So if you use cash 95. That will make your cash decrease 95, right? Also, to buy back your old bond, so your bonds payable will be decreased, right? But what's the problem? Bonds payable decrease how much? Bonds payable decrease how much? You should find out. It depends on what? What's the number? Okay, and cash you pay 95, for example. How to determine the 95? Okay, so our question problem is not journal entry. Cash decrease, of course. Old bond liability decrease, of course. But cash, how to determine 95? Bonds payable decrease how much? Okay, so bonds payable decrease means what? you should find out what is the bond's book value on this day, right? So you should find out, you should determine when you decide to buy back your bond today. So on your accounting books told you your bonds, the liabilities, how much right now on your accounting book. So you have to determine the book value of your bonds payable first, right? So how to determine your bonds payable book value today? You should do discount, premium, amortization, right? Okay. So this is from your first year. First year, what's that? You buy back your bond, bonds payable decrease. How much? You should find out today what is the book value, the number on accounting books. You pay back the cash. So how much money you pay? You should find out the redemption price, right? And for these two numbers, usually they will not the same. So the difference between these two numbers, you should understand this is your gain or your loss. Okay? Let's look at first one first. Book value. How to determine the book value? Remember? If your company issued a bond at a discount, right? And each period we should do what? Discount amortization. So your book value will be plus discount amortization to increase your book value to principal at the maturity date, right? So don't forget, start from present value, but your book value have to be adjusted to principal at the maturity date. No matter you are issued at discount or premium, totally the same. At the maturity date, your book value should be principal, right? Why? Because you promise paid principal back at the maturity date. Okay? So each period you have to do this kind of adjustment. So discount you have to increase to principal. Premium you have to be decreased to premium. So after you do discount, premium, amortization each period. So don't forget, you have to do discount, premium, amortization each period in order to find out the book value. Okay? So for example, after you've done discount, premium, amortization each period, then that's how we find out. Find out what? Find out your book value at redemption date, 赎回日. So that's how we find out our book value at redemption date. Okay? So this is the first step. Find out the book value. Otherwise, you don't know the number. You don't know the number, then how could you recall the situations? Okay? So you can use it this way. Start from present value. Then each period do discount, premium, amortization. Then you will find out the book value at redemption date, right? Another way is use this way. Based on principal. Principal go back to redemption date, still you will get the same result. Okay? So how? If I assume I have present value, for example, 80, principal 100. So means what? Discount should be 20, right? I have discount should be 20. And each period do discount amortization. So if I assumed is 80 plus 2, so will be 82. Next period from 82, right? So 82 plus, if I assume is 1, so you will get the book value should be 83. Okay, so I find out the book value at redemption date is 83. So how to get 83? You could start from 80 to get 83, or you could from 100, still you will get 83, right? How? 100 minus 17, right? So still from principal you can get 83 is 100 minus 17. So what is 100? Your principal face value. What is 17? $17 is your discount $20. $17 is your discount $20 minus 2 and 1. So it means what? You amortization $3 already. So you still have a $17 not yet. You didn't do amortization yet. Okay? So it is your 20 minus 2 minus 1. Okay, so either way depends on you. You want to go from present value to book value, or from principal to book value, either way. But because for your exercise problems, sometimes they will just give you this way, the information. They will just give you $70, the amount. So that's why I mentioned how to get it. Okay? Any questions? So this is how we find out the book value. So Book value means what? On your accounting books told you you have the liability $83. Okay, so this is on your accounting books. So look at the page 61. Book value at the redemption date. So you should find out your bonds payables book value at the redemption date first, right? Because you should find out how much, what is your liability today, redemption date. Okay? No problem? After that, this is the first number you should find out. So don't forget, this is the first number you should find out when we want to recall the situation. If you don't know the book value, you don't know your liability decrease how much. So at the redemption date, this is the first number you should find out. Then what's the second number you should find out? Pay the money back to buy the bond, right? So cash will be decreased. But what's the problem? How much money you should pay to buy back the bond, right? So how much money you should pay? We decide how much money you should pay at the beginning already. When you issue the bond, we made a deal with the creditors already. Okay? So actually they have the same formula as this one. Okay? So page 60 and page 62, they are the same. So second number we should find out is on your slide 63. Reacquisition price, redemption price, 赎回价格. How much money you should pay in order to buy back your bond. So this is the second number you should find out. Okay? But we determine the numbers when you issue the bond. It's on your contract already. So remember, on your bond, the promises you made. 4 basic promises is what? Principal. Second promise you made is maturity date, when you are going to pay the money back. Third promises is contractual interest rate. Fourth promises is interest payment date. When this bond is, do you remember we have a different kind of bond, right? So you can buy back the bond earlier. What kind of bond it is? Callable bond, right? Callable bond, 可赎回债券 means what? You could buy back your bond earlier, before maturity date. So actually today we talk about callable bond. So on the callable bond, since we agreed you could buy back the bond earlier, so we will tell them the details, the deal we are going to make. So you will tell them how much money we are going to pay if we decide to buy back the bond earlier. Okay? So here we'll, in the beginning we'll tell you the redemption price is, for example, 1110. What does it mean? 110% of your principal. So we decide the price already on your bond. So this is how we find out the second number, redemption price. Okay. So after that, I have book value, first number. I have redemption price, second number. So usually these two numbers will not be the same because book value based on accounting methods, discount, premium, amortization. Redemption price is the deal we made at the beginning. So usually these two numbers are not the same. So usually you will pay more money to buy the bond. Okay. So when you pay more money to buy the bond, for example, you pay more money to buy the bond means what? Your redemption price is higher than your book value. Okay? Pay more money to buy back your bond. So this transaction is your gain or loss. Loss, right? Pay more money to buy back your bond. So if your bonds payable liability, for example, just only $90, but your redemption price is 100. So what does that mean? My liability only 90, but I pay $100 back. So you pay $10 more. Since you pay $10 more, of course, that's your loss, right? So in opposite situation, if your book value is $90, but your redemption price is 85, so it means what? You pay less money for your liability, so you have the gain $5. Okay, so that's how we find out the three number we need. Okay, any questions? Actually, that's from your first year, but right now, based on the concept we already have, we want to make the case more real world. So what does it mean, more real world? Please look at slide 65. Actually, that's your problem 14 problem 14-8. So it means what? You should understand how to solve the problem, but it's quite difficult. So what's the problem? Your company sold the bond. So the bond principal $400,000, contractual interest rate 12%. Issue date June 1st, right? So the bond pay interest when? December 1st, June 1st. From this question, give it two very important hints. Always in this chapter, first, date, second, percentage. Because of these two things, okay? So be careful each date. So you pay the interest December 1st, June 1st, okay? The due date is June 1st, 2026, means after 4 years. Yield 10%. Yield 10% means what? Market interest rate 10%, right? So this is market interest rate 10%. Then, so for so far there's a normal bond. So what happened? October 1st, 2023. Your company decide to buy back bond. Okay? The bond worth how much? $120,000. For how much? $126,000. So this is your redemption price. But what's the problem? This price include interest. So it's not redemption price. It's redemption price plus interest. So this number including two parts, including redemption price and interest. And also your year end is December 31st. Year end December 31st means what? You prepare financial statement on this date. So this is the day you prepare financial statement. Okay, just look at the first hint, date. Could you tell me? Any additional issue we've mentioned already on this case? We mentioned two additional issues, right? First is interest payment day is not the same financial statement day. So do we have the issue in this case? Interest payment date and financial statement day are the same or not in this case? They are not the same. Okay, so this is the first problem. Second additional issue, our issue date and interest payment date, they are the same or not? Our issue date and interest payment date, they are the same or not? They are the same. So you don't need to worry about the second issue, but you have to worry about the first issue. Okay? So that's only for the bond. Second one, when you buy back the bond, when you buy back the bond? October 1st. What's the problem? When you buy back the bond, it's not the same date as interest payment date. So that's another problem. Okay? So for the date, always you should be very careful. They are on the same date or not. Okay? Second one, percentage. Could you tell me you buy back all the bond or not? All the bond, how much for your principal? $400,000. That's all the bond you have. You buy back the bond, is 100%? No, it's not. You just buy back $120,000. So you didn't buy back 100%. So how many percentage of bond you buy back? So did you find out? This is the two key words. You should be very careful. Okay? So this is all the information we have. Based on this, then, did you find out issue date and interest payment date, they are the same, so no problem for issue date. Based on contractual interest rate and market interest rate, I know let's issue at premium. Based on what? Based on year end, I know financial statement date is not the same as interest payment date. So you should be careful about this one, because financial statement date and interest payment date, they are not the same. About buy back the bond, you buy back the bond on October 1st. So you should be very careful. Why? Because redemption date is not the same as interest payment date. So since they are not on the same date, you should count how many months, right? Okay. Redemption price $126,000 include interest. So means what? The number include redemption price and also include last time interest. So based on this, you should figure out how much for your redemption price. Okay? Then you buy back the bond, how many percentage? Only 30%. Okay? So based on this, what's the problem? So many problems. If you understand how to solve the problem, should be no problem for chapter 14. Okay? Because did you find out so many things? You should be very careful. Okay, so before you buy back the bond, be careful financial statement date on which date. So since financial statement date is not the same as interest payment date, you should be careful. It's only 1 month. Is 5 months. So that's the first issue. You should be careful. Then redemption date, you buy back the bond before maturity date, right? But you buy back the bond only 30%. So remember, when you do all the things, when you calculate all the numbers for the bond you buy back, only 30%. Only 30%. So based on 30%, you should do calculate all the number you need. But for buy back the bond, for the 30%, don't forget, when I decide to pay the debt, always you have to what? Pay the last time interest, right? So that's why step 1, last time still I have an interest I have to pay back. After you pay last time's interest, don't forget, when we record interest, we record premium amortization at the same time in order to find out our book value on that date. Okay? And for our last time interest is for 6 months. The problem is still it's not on the same day as interest payment day, right? Since it's not on the same day as interest payment day, so you should what? Calculate how months it is. So how months is it? From this to this is 4 months, right? So this is 4 months. So it's not 6 months, it's 4 months. So did you find out? First keyword, date. So 4 months. Second keyword is what? We just buy back 30%. So all the number you should base on 30%. So this is the second keyword, percentage. So based on 4 months, based on 30%, these two keywords, you will find out the number you need. Okay? So interest, last time you pay interest from June 1st to today, October 1st, you have to pay last time interest. How much? Principal times contractual interest rate for only 4 months, but you just buy back the bond 30%. So the interest you have to pay is $4,800. Okay? For premium amortization, still you have to do the same thing, but we don't know the number yet. After finally we pay last time interest, then could you find out the 3 number we need, right? So what are the 3 number we need? First, the book value at redemption date, right? So this is the first number we need. So how? Based on last period, plus you do some premium amortization today, right? So how to get a number is based on last period, book value, last period is premium amortization. Last period. So should decrease what? Decrease the number we got from what? From here, right? So if that's A, so based on that A, we will get the book value at redemption price or redemption date. Last period minus premium amortization. Okay? So this is the first number we need. What's the second number we need? Redemption price, right? So second number we need. But the question told us $126,000 include interest. So we want to find out the real redemption price. We should minus the last period's interest. How to get it? Here, right? We find out from step 1. So from step 1 here told us the interest is $4,800. So finally, we could find out our redemption price is $121,200. So I know first number, I know second number. Based on first number, second number, could you find out this is your gain or loss? So based on these two numbers, I will find out this is my gain or loss. Okay, any questions? So redemption date here only for the 30%. How about the other 70%? Have we done anything for the 70%? No. 30% we buy back, 70% still in the market. So we haven't done everything for the 70%, right? So the 70% we do the same thing as before because we haven't done anything for the 70%. But only thing you should be careful is we have only 70% left in the market. Okay, so in the market only 70%. So all the numbers is only for 70%. Okay, so that's the concept we have. Any questions for the concept? Before we finish today's class, so let's look at this table on your notes. You will have a clear idea. Page 24. On your note, page 24. So that's the whole structure, whole picture we have. So for before you buy back the bond, the only thing you should be careful is the date. Okay, the date. So you should think about when we prepare financial statements on this date. So be careful about the date. So this is the first keyword, date. Should be careful. Okay? Then when you decide to buy back the bond on October 1st, but October 1st, you want to buy back the bond only 30%. Okay? So since you decide to buy back only 30%, so means what? 30% we want to buy back means the other 70% still in the market. Nothing changed for the 70%. So you have to think about these two kind of situations separately. So for the 30% you want to buy back, then 30%, but for how long? You buy back the bond on October 1st. So October 1st is not the same as interest payment date. So be careful, only for 4 months. So did you find out? First keyword date, second keyword percentage. So you should be careful for date and percentage, these two keywords. Okay, so after you find out date and percentage, get the correct numbers. Okay, so that's quite important. So that's for 30%. How about the other 70%? You have done anything. So for the other 70%, do the same thing as before. But be careful, only you need to be careful. We have only 70% left. So you have only 70% left. So when you do any numbers, only for the 70%. Okay? Any questions? So that's the structure picture right here. But because we don't have time, so next week we based on this to practice how to get the numbers. Okay? So see you next week.